Forex trading is often shrouded in mystery for beginners, with terms like leverage and margin adding to the complexity. However, understanding these concepts is crucial for successful trading and risk management. In this article, we'll demystify leverage and margin in Forex trading, providing clarity on how they work, their benefits, and potential risks. 1. What is leverage? Leverage is a double-edged sword in Forex trading, amplifying both profits and losses. It allows traders to control larger positions in the market with a smaller amount of capital. For example, with a leverage ratio of 100 to 1, a trader can control a $100,000 position with just $1,000 in their trading account. While leverage magnifies potential gains, it also increases the risk of significant losses if trades move against the trader. 2. Understanding margin. Margin is the collateral required by brokers to open and maintain trading positions. It is expressed as a percentage of the total value of the position. For example, if the margin requirement is 1%, then a trader would need to deposit $1,000 to control a position worth $100,000. Margin acts as a buffer against losses, ensuring that traders have sufficient funds to cover potential losses and meet margin calls from their brokers. 3. The benefits of leverage. Leverage offers several benefits for Forex traders. Firstly, it allows traders to maximize their trading potential by controlling larger positions with a relatively small amount of capital. This can lead to higher profits compared to trading with cash only. Additionally, leverage enables traders to diversify their portfolios and take advantage of trading opportunities in different currency pairs without tying up large amounts of capital in each trade. 4. The risks of leverage. While leverage can amplify profits, it also increases the risk of substantial losses. Because traders are controlling larger positions with borrowed funds, even small price movements can result in significant losses. High leverage ratios such as 500 to 1 or 1,000 to 1 can magnify this risk even further. Traders must exercise caution when using leverage and implement strict risk management strategies to protect their capital. 5. Margin calls and stop-out levels. Margin calls and stop-out levels are mechanisms used by brokers to manage the risk of leveraged trading. A margin call occurs when a trader's account falls below the required margin level, prompting the broker to request additional funds to cover potential losses. If the trader fails to meet the margin call, the broker may liquidate their positions to limit further losses. Stop-out levels are predefined thresholds at which brokers automatically close out a trader's positions to prevent their account from going into negative balance. 6. Risk management strategies. Effective risk management is essential when trading with leverage. Traders should never risk more than they can afford to lose, and should always have a clear understanding of their risk tolerance and financial goals. Risk management techniques such as setting stop-loss orders, diversifying trading portfolios, and using proper position sizing can help mitigate the risks associated with leverage and margin trading. Conclusion. Leverage and margin are powerful tools in Forex trading, allowing traders to maximize their trading potential and take advantage of market opportunities. However, they also come with inherent risks that traders must be aware of and manage effectively. By understanding how leverage and margin work, implementing strict risk management strategies, and exercising caution, traders can harness the benefits of leverage while protecting their capital from significant losses. Ultimately, successful Forex trading requires a balance between risk and reward, and mastering leverage and margin is essential for achieving long-term success in the dynamic and competitive world of Forex trading.